The European Central Bank (ECB) has issued repeated warnings about the rise of stablecoins. The ECB can control the common currency within the European environment, but the arrival of external digital currency stablecoins used by Europeans as an alternative to the euro poses a risk. Some citizens might prefer a stablecoin pegged to the dollar, such as those from Circle or Coinbase, or even one linked to gold in the future, which could jeopardize European monetary strategy. According to the ECB, the expansion of these currencies calls into question Europe's ability to control monetary policy and combat inflation. Currently, over 99% of the global stablecoin market is dominated by dollar-pegged versions, which increases European dependence on the U.S. financial system and weakens the euro's strategic autonomy. If their use becomes widespread, the phenomenon of dollarization seen in emerging economies could be replicated, with a potential migration of deposits from traditional banks to private digital assets, risking financial intermediation and credit availability within the Eurozone. Christine Lagarde, president of the ECB, also points to the danger of a privatization of money and warns that if stablecoins were to massively displace the euro in daily payments, the ECB would lose its power to intervene in the real economy. For this reason, Europe is betting on the development of the digital euro and the implementation of MiCA markets in crypto assets, a pioneering regulatory framework that establishes strict requirements for transparency, authorization, and supervision over crypto asset issuers and related services. This approach seeks to mitigate risks for consumers and reinforce the stability of the system, but it imposes significant restrictions on innovation and new blockchain-based companies. In contrast, the United States has spurred crypto innovation by passing laws like the Genius Act, which provides a clear and favorable framework for dollar payment stablecoins and protects their development as an international anchor of liquidity. Through recent executive orders, the Trump administration has reinforced a pro-blockchain vision. It prioritizes free access to blockchain networks, promotes dollar-backed stablecoins, and expressly rules out the creation of a centralized state digital currency (CBDC). Furthermore, the United States is seeking to create a strategic reserve of Bitcoin and to lead the global infrastructure for digital assets, with the goal of solidifying itself as the epicenter of global digital money. The result of these policies is a fundamental difference. The United States is committed to providing legal certainty, market freedom, and incentives to the crypto sector, thereby attracting talent, companies, and international investment. Meanwhile, Europe, due to its focus on stability and risk prevention, favors strict regulations and conservative responses. This leads to a lack of dynamism. Companies and capital flow toward markets with more flexible regulations, like the US, leaving the Eurozone relegated and dependent on the system led from Washington. Ultimately, the American strategy of liberalization and technological leadership is allowing international capital, innovation, and startups to seek refuge there, consolidating the United States as the crypto sector's superpower. Europe, despite its early regulatory progress, is placing obstacles in its own path that hinder competition, adaptation, and the integration of the euro into the global digital ecosystem. Thus, while Washington advances towards strategic dominance, Brussels faces the threat of losing its monetary prominence in the digital economy of the 21st century. Visit website colinfastcryptonews.com.